Okay, it's now time. I think tunokwanisa kutanga zvedu. So, welcome to our first session, Financial Accounting 2A. So, let me just show you what we are supposed to cover. So, maranzi pa munofana cover from what chapter to what chapter? Magambunge ma Okay. Okay, so this is the module that you're going to be using for Financial 2A. So let's just go through the topics that we have to cover. So I'll just confirm, I'll check it's up to what chapter, but of course you're going to cover Unit 1. So Unit 1 is talking about the limitations of financial accounting, the techniques used in financial analysis. It's a very short unit. We are going to cover that today. Then Unit number 2 is talking about interpretation of financial statements. We are also going to introduce it in today's session. So Unit 3, Bill of Exchange, we are going to cover that. Partnership accounting, company accounting, the cash flow statements. I think for this semester, you're supposed to cover up to Unit 7, if I'm not mistaken, because those in Fin 2B, I think they start from Unit 8. So without wasting much time, let's get started. So we're going to start with Chapter 1. So Chapter 1 is all about understanding IAF. Maybe let me just take you through a quick recap. For financial accounting, what is it that we will be doing? So for financial accounting, it's all about telling us the performance of a company. So during the period, the company is going to be trading, then we need to be able to tell whether the company has made a profit or the company has made a loss. So if we are looking at financial accounting, it's all about reporting how the business has performed. But the Padachi operator during that period, did we make a profit or did we make a loss? So the first topic that we are going to talk about is financial analysis. So if you are analyzing the financial performance of the business, what is it? So financial analysis. So the reason behind preparing the financial statements, the reason behind coming up with the income statement, the reason behind coming up with the statement of financial position is so that we can be able to make decisions out of the financial positions. Sorry, out of the statement of financial position or out of the income statement. So we prepare accounting records so that we can be able to make decisions concerning the company. And so we prepare the financial accounts in order to show how the business has performed. So that the users of the accounts, so that the various users can make decisions out of the information. So to prepare different types of my accounts so that the different users of accounts, they can make decisions out of the accounts. So who are these users? So, but know that I prepare the income statement, a statement of financial position. Tinenge to prepare number one, not my shareholders. My shareholders know an company, they invest their money in the company, but the shareholder does not run the company. Of course, it's possible in private entities, but the shareholder can also run the company. So, Just a moment. Okay, so I was saying, we prepare these financial statements for the sake of the various users. And I was now explaining one of the users, which is the shareholders. So the shareholders of a company, they invest their money in the company, but they don't run the company. So what happens? The company, my shareholders, but Batanga, the company, they don't run the company. They leave it in the hands of my directors. So the reason why I prepare my financial statements is so that my shareholders vakwanise kuona kuti vanhu vatakasiyira company vari kugona here kuirana nenzira yatatitarisa, so that they can be able to tell whether the company is making a profit or the company is making a loss. So patinonovaudza feedback sema-directors on how the company is operating. Hatingoende tichinovaudza nemuromo. We provide the financial statements to them. So the shareholders, they use the financial statements in order to tell how their investment is doing. So they use financial statements in order to tell whether their investment is being properly utilized by the directors. So it is the directors that will be given the mandate to run the company. So ivo vanozongonotarisa mafinancial statements vaone kuti company yedu iri kuranwa zvakadii. And so besides the shareholders, who else gets to use the information that we have produced? So we produce these financial statements so that the managers themselves can get to use the information. So the managers and directors, managers or directors. So how do they make use of the information? They make use of the information to make plans for the future. So vanotarisa information yatakarekoda, how the entity has been operating in the last year, so that they use that information to make more decisions for the future. So kana company ikanzi maybe last year takaita loss, vakuona maoperator atakaita vaona kuti what should we not do zvatakakanganisa last year, so that next year decided the same mistake. So they make use of the financial statements so that they make future decisions. So the managers or directors, they use the financial statements recorded, or they use the financial statements for making future decisions. So they're the ones that are going to be running the company. They use the financial statements so that they make decisions for the future, so that they decide how best the company must be run. So vanoshandisa the information yatinayo operator watakaita last period. So the other person who gets to use the information we have reported are the employees themselves. So information yet not prepare is also used by the employees. The employees, they use the information how? Can a company can the operator, the employees, how is the business doing? Because they are part of the people and organization to meet them objectives. Chinotifads as my employees because my targets achieve. We is not power job security because the company and kushandira irikuita profits. Because the company irikuita losses. There is a high chance company no one kuvara, basa no one repair. So if the company that I'm working for irikuita profits, it's something that can give me assurance. It's something that can also give me motivation. So through kwanisa achieve and it won't be something nice when the company and kushandira hapana target one atakamita, we're making losses. So the financial statements, they are also used by employees. So the employees use the financial statements to assess the profitability of the company and how able they were to meet the objectives. It's also a basis for advocating for higher salaries and wages. Kana tikaona kuti company iri kuita ma-profits, we can also say time atiwedzerawo mapay. So we need to see ma-financial statements kutiona kuti company yedu yambopefoma zvakadii. Kana tikaona kuti no, company yedu yapefoma sezvatatichitarisira. So this can also give us the push yekuti aiwa saka dai company yatiwedzerawo mari. You can't say dai matiwedzera mari muchiona kuti company iri kuita ma-losses. So if we can see the financial statements, how is the company operating? So let's move on. So besides the shareholders and the directors and the employees, we also have the creditors. Vanhu creditors in accounting, these are the people that provide goods to us on credit, like our suppliers. So the creditors. So the creditors or suppliers, these ones are more concerned with, are we able to pay them back? Are we in a position? So they look at the financial statements. Our financial healthy. Business rate, is it in a position? So they use the financial statements to assess the ability of the business they use the financial statements to assess the ability of the business to pay their debt. So before they want to see, are we able to pay? So if we can provide my financial statements, they can be able to assess our ability to pay the debt, and also my suppliers company. Why does it make them happy? It means suppliers now there's a potential they can supply more. So the creditors or the payables, they also want to see our company grow, because as the company grows, it means they are likely going to supply more. So the creditors also want to see the financial statements for those purposes. Then besides the creditors, we also have the government. The government is another user of the financial statements. So the government, why does it need the financial statement? So maybe besides the government, we could say the regulatory authorities. So every company, inofana tax. So the regulatory authorities, such as ZIMRA, they want to see how much tax you are supposed to pay and how much you've paid, in fact. So they are interested in my financial statement so that they can assess corona tax ya mufano kubada. And it. So the government is concerned. The government is concerned with the profits and the taxes paid. That is, are we tax compliant? Did we pay tax on all the profits that we made? So the government is looking at, are we tax compliant? Because from the profit that you have made, you are required to pay tax. We can also look at the other users, such as the lenders or the bank. although they are almost the same with the creditors there. So we have the lenders and the bank. Lenders, or we can say loan providers. So these ones, again, they assess the ability of the business to repay, or we can say the collateral. They use the financial statements to determine the collateral security. They use the financial statements to determine the collateral security. So if we have collateral security, it means we have assets anokwanisa kubhadhara zvikwereti. So we have enough assets to repay back tikanzi tapiwa mari nechikwereti. So we are going to use the financial statements as maybe shareholders can get the current shareholders or even potential shareholders. So potential shareholders, or we can call them not potential shareholders, let's call them investors. Potential investors. So the potential investors, they want to see whether it's worth investing in the company or not. So the potential investors, these want to assess whether the company will give them a higher return on investment. So these assess whether the company will give them the required return on investment. Vasati vaisa mari yavo, they want to see kuti kana mari yakudzoka inodzoka iri mari ndiyo here mari yatiri kudai. So they look at the financial statements and they assess the return on investment. Zvireva kuti mari yatinoitaisa inodzoka yamari. So kana company ichivapa a higher return, they are likely to invest in that company. So they use the financial statements kuti vaone kuti what is the return. Pamari iri kuinvestwa in this company iri kudzoka yawanda zvakadini. And so they use the financial statements to assess the return on investment. These financial statements, of course, yes, they are good. They can tell us how the business is doing, but we cannot 100% rely on the financial statements. So there are limitations of financial statements. So let's have the limitations of the financial statements. Limitations of the financial statements. So we can't rely 100% on the financial statements as we make decisions. Why can we not rely 100% on the financial statements? The financial statements, or financial accounting rather, the financial accounting inongotiudza how the business has performed financially, but haitiudze non-financial issues, such as what? So company inogona kuita profit, but my customers are complain. So if the company ikanziri kuita ma profits but my customers are complain, company iyoyo, there are less chances of it surviving for a long time. Why? Because my customers akazongoona an alternative, vanoregera kuya kuzotenga vakutenga ku. So iwewe as an investor, if you just rely on the fact that the company is making a profit, you can put the investment wesa mari yako imomo. Then you realize later on that the company, yes, it was making a profit, but all customers were threatening to pull out. Soon after, every major customer pulled out. And why? Because the financial statements, the financial accounting, it was showing us that we are performing well, but it was not telling us non-financial issues, such as the customer complaints. So that is the first limitation. It does not indicate non-financial performance measures. Non-financial performance measures. Such as customer complaints. Such as the customer complaints. So it only tells us how we're doing financially, but it does not reflect the non-financial issues. It does not reflect the non-financial issues. Now let's move on. The financial accounting, the other problem that it has, it only tells us what has already happened in the past. So haisikuti udza zvichaitika mberi, but financial accounting iri kutiudza how we have performed in the past. So it tells us what has already happened. And does not prepare us enough for the future. If we allow preparing ourselves for the future, we use management accounting. Of course, the managers, they can make use of what has happened to prepare for the future. That now is called management accounting. So financial accounting is all about telling us how the business is performed. So it tells us the past. It's not actually telling us what will take place in the future, but it's telling us what has already happened. So we say it gives us historic information. Financial accounting, it gives us historic information, which is information that has already happened. That's the other issue with financial accounting. Then besides it giving us historic information, let's move on. Financial accounting, it can be affected by personal bias. Or we can say the accounts may be window dressed. The accounts may be window dressed. To portray a good picture. So the financial statements, they can be window dressed. There are certain areas where the managers can play around with. Could it read as if the company is doing well, while it's not? Especially areas that are judgmental. Pagoti panama estimation. The managers can understate. If I estimate, maybe my expenses are 100. They can say my expenses are 120. So they can understate my expenses. Company it as if it will gonna operate. So because the financial statements are prepared now, they are subject to window dressing. So there's a danger if we rely entirely on the financial statements, especially if they are not audited. They may have a lot of errors and mistakes. So if we are looking at the financial statements, we then need to be able to make decisions out of the financial statements. So remember the topic I had written on top is financial analysis. Now, if you have the financial statements, how do you analyze the financial statements? So in order to analyze the financial statements, in order to analyze the financial statements, the following techniques may be used. So if you're analyzing the financial statements, you want to tell whether the company is doing good or bad. So we want to analyze and see whether the company is doing good or bad. So we have The first technique we can use, we can make use of the vertical analysis. We can also make use of the ratio analysis. Or we have the trend analysis. So the common one we're going to talk about in detail is the ratio analysis. So the vertical analysis and the ratio analysis, they are actually related. So for the vertical analysis, we express the performance as a percentage of, for example, how the business is performed. We can express our profit as a percentage of sales. We can express our expenses as a percentage of sales. So we express as a percentage of something, then you compare with another period. So the vertical analysis, it applies actually something is the same principles with the ratio analysis. So the main one that we are going to discuss much about is the ratio analysis. So the trend analysis is just looking at whether over a period of time, what is taking place over a period of time. So if it's a trend, we are studying what is taking place over a period of time. So the sales can be said to be having an upward trend. It means they've been rising over a period. The profit can have an upward trend. It has been rising over a period. So if it's the trend analysis, you are studying the change that's taking place over time. For the trend analysis is the change that is taking place over time. So the main one that we need to know much about is the ratio analysis. We have the ratio analysis. So if we are using the ratio analysis, ratios are used to compare similar periods, or ratios are used to compare two similar periods or companies. They are expressed as a percentage, proportion as a percentage. Can you have the ratio as a percentage, as a proportion, or rate? Can you have the ratio as a percentage, as a proportion, or as rate? If you are analyzing performance using the ratios, you can measure the performance using, or you can assess the performance using profitability ratios, or you can say types of ratios. So if you're analyzing the performance, you can make use of ratios. So which are the types of ratios that we can make use of? So we have the profitability ratios. Besides the profitability ratios, we have the solvency ratios. Besides the solvency ratios, we have the efficiency. We have the efficiency ratios, and we have the shareholders. or we can call them investment ratios. So let's start with the ratios that we classify under profitability ratios. So for the ratios that we classify under profitability ratios, these ones are used to measure whether the company has become more profitable or not as compared to the previous period or as compared to a competitor. So tutarisa gonoti, is the company becoming more profitable? Is the company becoming more profitable? So this measures whether the company is becoming more profitable or not as compared to a previous period. The company is becoming more profitable or not as compared to a previous period or company or previous period or similar company. As compared to a previous period or similar company. So the profitability ratios, which ratios do we have under profitability ratios? So it's not just one ratio. The profitability ratios is a number of ratios that we use to assess the profitability of the business. So the first ratio, we can talk about the gross profit margin. So the first ratio is the gross profit margin. So the gross profit margin, the formula of Chagana is the gross profit margin, not the gross profit over revenue or sales times 100. So it's the gross profit over revenue times 100. If comparing two companies or two periods, the higher the ratio, the better the performance. So a higher ratio indicates better performance. The higher the ratio, the better the performance. So as an organization, we should seek to have a higher gross profit margin. What does having a higher gross profit margin mean? This means that we have been able to get more, because whenever we sell, there's a profit. So the gross profit margin is saying from every item, how much profit have you made before looking at expenses? If the gross profit margin is 10%, you're saying whenever you sell, you're making 10% gross profit. So if you have a higher percentage, it means you're making more profit from every item you're taking. So this measures the gross profit derived from every item of sale. It measures the gross profit derived from every item of sale. Then besides the gross profit margin, the other margin is the net profit margin, a net profit margin, or we can call it the operating profit. So the operating profit margin is just the operating profit over revenue. So SMA margin is over revenue times 100. So Musiano Ndeweguti, the operating profit is looking at the profit after removing expenses. But the gross profit is the profit before expenses. So still the same applies. The higher the ratio, the better. So it measures the net or operating profit derived from every item of sale. So the operating profit or the net profit margin is measuring from every item to the thing is how much operating profit are we making? If it's 10%, it means if you sell for $100, then 10% of $100 is the operating profit. Now let's move on. We also have, the markup. So we have the markup. So that's the gross profit over cost of sales times 100. What is really the markup? When you buy something, you add a profit to it. So you buy something at a certain cost, you add a profit to the cost. Profit in selling price, imagine. Profit upper cost is the markup. So the markup, it is the profit added. It is the profit added to the cost in order to get the selling price. The profit we add to the cost to get the selling price, that is the markup. The markup is the profit we add to the cost to get the selling price. For all these ratios, the higher the better. The higher the better. Now let's move on. We have a return on capital employed. So if you're looking at return on capital employed, what happens is when we start business as investors in the company, we are going to put our money, which is the capital we are going to invest. So whenever you put your money in the business, you are hoping that it is going to come back, or it's going to become more or generate more profit. So we are saying from every cent that I injected, how much benefit are you getting? That's the return on capital employed. So from what you invested in the company, how much are you getting back as your benefit? So the return on capital employed, we say the operating profit over the capital employed. So it's the operating profit over the capital employed times 100. So the capital employed in the business. So this looks at how much we are getting back from the capital that we injected in the business or that we employed in the business. So the return on capital employed from what we invested in the company, how much are we getting back? That's the return on capital employed. So these are part of the profitability ratios. Let me add one more. We have the rate of stock, the asset turnover. So the asset turnover, this one, we say the turnover or sales is the same as our sales, our turnover over capital employed. The answer is not a percentage. We don't multiply by 100. This one, the answer is just it's a ratio. Let's say if the answer is 3, you say 3 as to 1. If you say as turnover over capital employed, if you get 3, you then say as to 1. You just say the ratio as to 1. So we can say this looks at, maybe let's start from the fact that having assets in the business, the purpose of having assets in the business is, so this is asset turnover ratio. Asset turnover ratio. So the reason why we have sales, we have assets in the business, they are supposed to be used to generate sales. Tinotenga assets in the business so that they can be used to generate sales. So kana assets tinawo mu business, kana akanzi ari kushandiswa zvakanaka, it means we should have more sales because tatenga more assets. It's pointless buying more furniture and mari yamuri kuwana haisi kumbochinja. So you should buy more assets. As you increase the assets, they should also increase the revenue. So asset turnover, how able are we to utilize the assets to bring us sales? So this measures the ability of the firm to utilize the assets that it has in order to generate sales. A higher ratio means the business is doing well. A higher ratio means the business is doing well. A higher ratio means the business is doing well. A higher ratio means the business is doing well. Then capital employed may not be given in some questions. Capital employed, how do you get capital employed? So the capital employed, you add all the assets. You say total assets. So the total assets, that's the current plus fixed assets. So you say the total assets minus the current liabilities. So that's the capital employed, the total assets minus current liabilities. That's our capital employed. The total assets minus the current liabilities. Then another key thing to take note of, we're talking about operating profit. Operating profit, if we are not given operating profit, if they don't give you the term operating profit, it is the same as, so operating profit is the profit before interest and tax. So the operating profit is the profit before interest and tax. The operating profit is the profit before interest and tax. So the operating profit is the profit before interest and tax. So if they give you profit, the one that we want is operating profit is before interest and before interest. Interest can be called finance cost. So it's before interest and tax. It's before interest and tax. So please take note of that. So those are the profitability ratios. So if you are assessing the performance, you can assess the performance based on profitability. So the higher the profitability ratios, the better the performance. And B, if analyzing the performance, the higher the profitability ratios, the better the performance for the business. The higher the profitability ratios, the better the performance for the business. So our aim is to have higher profitability ratios. Our aim is to have higher profitability ratios. Now let's move on to the next type of ratios. So these were profitability ratios. Let me call them A. The other type of ratios we have the liquidity ratios. Liquidity or solvency ratios. So what do they have in common? Ratio it's a liquidity ratio. Measure kuti tinokwanisa here kubhadhara zvikwereti zvedu in time. So it measures the ability of the firm to repay its debt in time. Measures the ability of the firm to repay its debts in time. Are we able to pay those we are owing? Are we in a position to repay those we are owing? Let's move on. So the solvency ratios. The first solvency ratio we're going to talk about is the current ratio. So Tati, we are measuring the ability of the business to pay those it is owing. So the current ratio, what does this one look at? So the current ratio, inenge ichitarisa kuti tinokwanisa here kubhadhara those that we are owing using all current assets. So this one, it measures our ability to pay. It measures, sorry, before we get to that, what is the formula? So the current ratio is the current assets divided by the current liabilities. I'll demonstrate an example for that. Then it measures the ability of the firm to repay all those that we are owing using all current assets. So if it is the current ratio, inenge ichizoona kuti tinokwanisa here kubhadhara vanhu vatiri kukwereta tichishandisa macurrent assets ese. So anonzi macurrent assets mubusiness, tinoona kuita example of all current assets. Tinoona kunzi isusu we have inventory, that's stock, 20,000. Can you have trade receivables, normal debtors? Trade receivables, let's say 12,000. You can have cash in hand, which is cash, 2,000. You can have prepayments. These can be part of the current assets. Then we can also be given the current liabilities. So what's the total for the current assets? So our total for the current assets becomes 35,500. Then we have the current liabilities. So for the current liabilities, we can have trade payables. We can have accruals. So for the trade payables, let's say 21,000. Accruals, 1,200. So we are given the current assets and the current liabilities. Then the question says, what is your current ratio? Your current ratio is the current assets as to current liabilities. So in this case, our current ratio. Tinoona kuti my current assets, 35,500, divided by current liabilities, 22,200. So if you say 35,500 divided by 22,200, you get 1.5. So it becomes 1.5. If you round to the nearest whole number, it's 1.56. If it's a current ratio, it's as to 1. So you say the answer is to 1. So if the current ratio is greater than 1, it means we are able to pay those that we are owed. So if the current ratio is greater than 1, it means that the company has enough current assets to pay the current liabilities. So the current liabilities, etc. So a business should pay the current assets, so current liabilities using current assets. We should take either money from the bank, current liabilities. So if the ratio is greater than 1, it means my current assets, they are enough to pay the current liabilities. So a ratio greater than 1, it means my current assets is enough to pay the current liability. However, if you're analyzing the performance, the ratio must not also be too big. So if the current ratio is too big, that is greater than 2.5, it indicates poor working capital management. If the ratio is greater than 2.5, it's poor working capital management. And if it is less than 1, if it is less than 1, it indicates that we do not have, enough funds to pay those we are owing. We do not have enough funds to pay those we are owing. So a good ratio should lie in the range (1 to 2.5). So the ratio must not be too low, it mustn't be too high. So let's move on. Besides the current ratio, we also have the acid test, or they can call it the quick ratio. So the acid test or quick ratio, this is a ratio inoshandiswa kuti tione kuti tinokwanisa here kubhadhara zvikwereti tisingatembe mari iri mustock. So if we look at the current ratio pana, iyi imari ida kubhadhara, iyi mari yatinayo, iyi mari iri current assets zvichireva kuti imari yatotarisira kuti tinenge tinayo within a year. Anditi izvi zvikwereti zvifanira kubhadharwa within a year. So mari yedu yatinayo iri kukwanisa kukava zvikwereti. That one is good. But pamari yatiri kuti tinayo iri kuinclude stock, of which munhu akauya achindoda mari yangu nhasi, hatikwanise kutora stock kutobva taichinja kuita mari, because stock it depends nekuti macustomer auya kuzotenga. Of course imari yekuti ichakasika kuchinjwa before gore risati rapera, but you cannot force the customers to buy. So in the event that someone is in need of the money today, we cannot change the money into cash. Mari iri mustock hatikwanise kuichinja quickly into cash. So in that case, tinenge tichiti isusu, that's why we need to calculate the quick ratio. The quick ratio iri kuti tikanzi we want to pay, are we able to pay without relying on inventory? So it says the formula inoti, the quick ratio or asset test, to current assets minus stock. As to current liabilities. So tinokwanisa here kubhadhara zvikwereti without relying nemari iri mustock. A good ratio should be close to 1. So this measures the ability of the firm to pay those that it is owing without relying on the money which is in inventory. Are we able to pay those that we are owing without relying on the money which is in inventory? A good ratio depends on the nature of the company's transactions. Depends on the nature of the company's transactions. For a company that sells slow-moving goods, the ratio should be very close to 1. But for companies that sell fast-moving goods, the ratio can be lower. So the quick ratio, it also depends on the nature of the company. If we are dealing with things as a supermarket, on a daily basis, the ratio can be lower and acceptable. But the ratio should be 1 or very close to 1. Let's move on. Efficiency ratios. So these look at how the assets have been utilized. So I think the asset turnover can also be put here. This so the efficiency ratios, these look at how the assets were utilized. At how the assets were utilized. So the assets of the business, we can either use them for the benefit of the organization or we can misuse the assets. So the efficiency ratios will look at how good were we in terms of utilizing the assets. So I think the asset turnover again at Adambo, so we can put it at efficiency. I think that is the right position instead of putting it kuma profitability. The asset turnover, let's include it kuma efficiency ratios. Because the definition would say this measures the ability to utilize the assets. So, sorry, for this one, let's include it under efficiency. So if the asset turnover ratio, and we have explained it, then the other ratio, let's say, besides the asset turnover, we can also talk about the inventory turnover. So inventory turnover days. So inventory turnover, it can be calculated in 2. So it can be calculated in days or it can be calculated in times. So let's start with days. So we are looking at, if it's in days, we are saying, how long does it take after you've bought inventory? How long do you take before selling that inventory? So if you buy inventory as a business, the aim is to resell that inventory. So calculating how many days we are taking with inventory, we say the average inventory over cost of sales. times 365. So this will give us how long, how many days are we taking with inventory in our warehouse. So we can calculate it in terms of days or in terms of times. In terms of times, you're saying how many times are we replacing inventory in a year? If we buy the inventory, how many times do we replace it in a year? So you just invert the formula, you say cost of sales over average stock. And you don't multiply by 365. So we can say the inventory turnover in days measures how long the business is taking with inventory in its warehouse. For a good business, we shouldn't have inventory for a long time in the business because the inventory can get deteriorated. So we want to put inventory tikangoitenga ngaisagare business, ngaikasike yabuda. So a good business has shorter inventory days. A well-performing business has shorter inventory days. So if you are given the days, we prefer shorter inventory days. Let's move on. What about in times? The inventory turnover in times. Looks at how many times we replace inventory. How many times we replace inventory. A higher number of times means a higher number of times indicates better performance. So how many times, if we if you are replacing inventory when it replenishes, how many times are we replacing? So if you replace more, it means you're selling more. So that's the inventory turnover. It can be in days, it can be calculated in times. Then we have the receivable collection period. Receivable collection period. The receivable collection period, this ratio is meant to measure how long does it take before we collect money ya true credit. The receivables are the debtors. These are the people that are owing us money. How long does it take for us to be given back? How long does it take for us to be given back Maria Tringeta Takwere? So that's the receivable collection period. So the formula, the receivable collection period, we say the receivables of credit sales, or we can use sales. If we are not given credit sales, just use revenue times 365. But we can say in bracket, if given credit sales, use credit sales, not revenue. If given credit sales, Use credit sales, not revenue. So the receivable collection period, how many days are we taking before receiving mari yatinenge tapa vanhu nechikwereti? So this measures this looks at how long are we taking before receiving the money due from our debtors. So from those that are owing us, how long are they taking before paying us the amount owed? So how long are they taking? That's the receivable collection period. That's the receivable collection period. Then besides the receivable collection period, we can also look at, besides the receivable collection period, we can also look at, maybe before we move to the next, let's talk about a good ratio. So for receivables, it's actually good to push vanhu vakasike kupa mari yedu. If the more we delay vanhu vane zvikwereti, vanogona kupedzisira vazoita ati not mabad debts. Munhu anotozopedza atadza kubhadhara, anotozotadza kubhadhara zvachose. So zvikwereti hazvidi kunyanya kugarisa. So the shorter the receivable days, the better the financial performance. Of the business. The shorter the receivable days, the better you can just say the better instead of financial performance, the better the working capital management. So why is it better? Because we reduce the chances of my bad debts. But also, tikanyanyonyima macustomers chikwereti, zvinogona kuita kuti tirasikirwe nemasales, because macompetitors edu akatanga kutengesa nechikwereti, isusu tisingape chikwereti, vanhu vanongoenda kunotenga nechikwereti. So you can say, however, if the days given are too short, the company may lose revenue. As most customers will shift and buy from competitors. Who give them favorable terms. So they might look for other competitors who are providing them with favorable terms. Then this was the receivable collection. Now let's talk about the payable days. Payable days. So if the receivable collection period, then we have the payable days. So the payable days, the formula for the payable days, we say the payables over cost of sales. times 365. If given credit sales, we use credit sales. Not credit sales, or credit purchases. We use credit purchases, not cost of sales. That is if given. But most cases you won't be given. So the payable days. The payables, these are the people we are owing, the suppliers, those that sold goods on credit to us. So the payable days, we are looking at how long are we taking tisatita badara credit. So this looks at the period we are taking. Before paying the amount due to our suppliers. How long are we taking before we pay the amount due to our suppliers? We should delay making the payment. The business must negotiate for longer days. Payable days. However, this can affect the credit rating of the company. If we always delay making payments, we might be flared so that next time but it's good, we should negotiate for longer days. Let's negotiate for longer days. After we negotiate for longer days, tononoka kupa vanhu mari, tomboitenderedza yomboitanga kushanda zvinhu. But challenge iripo ndekuti next time unogona kunyimwa zvikwereti secompany. Okay, so I have another lesson starting at 1:30. So for introduction today, let's end here. So you can go and read ahead. So far we've covered chapter 1 and chapter 2. So we're just left with a very small part for chapter 2. So going to look at that. Then in the next coming session, we'll finish up and move to the next chapter, and we'll also complete, I'm sure chapter 3, we'll complete it in the next coming session and introduce chapter 4. So thank you so much for your time. Let's meet again next week.